So the question will come from May 2018. Question number 5A. So I read the question. The following is the income statement of Savannah Limited, a manufacturing company, for the year 2017. We have the gross profit, foreign exchange gain, dividend from Hazina Cooperative Net, dividends from subsidiary company, less expense which we have directors' emolument, provision for depreciation, office furniture, computer software, donations, legal expenses, dividends paid, corporation tax, salaries and wages, net profit. Additional information number 1, the company operates in a factory building whose construction cost at the time of first operation on 1st January 2003 was 4,800,000. The cost of this building is included in the director's emoluments. The company installed processing machinery costing 2,800,000 in year 2003. On 1st July 2017, the company acquired portable packaging machine at a cost of 20,000, computers to 40,000, and weighing scale machine 48,000. Number 3, on 1st October 2017, the company put into use a staff canteen constructed at a cost of 780,000 and go down whose cost was 600,000. Legal expense include costs for the disposal of banned packaging materials 27,000, negotiating a loan agreement 36,000, processing legal document for a new factory plant 19,800, defending the company against lawsuit for smuggled goods by director 94,000, preparing patent document for registration 52,800. Gross profit was overstated by 20% and include figure for purchases of 340,000, which had been understated by 15%. Director's allowance include management fee of 495,000 from a director from one of the subsidiary company. Interest on loan of 96,000 from the head office was included in the director's emoluments. The interest was to be treated as received from a thinly capitalized company. So we are required to have number 1, statement of adjusted taxable profit or loss for the year 2017. Number 2, the tax liability, if any, for that year. And then comment on payment of tax for that year, assuming tax had been paid during the year 2017 based on the previous year tax of 2,400,000. Note, use capital allowance rates applicable in the year of assets acquisition. So we look at the first question where we are supposed to get the statement of adjusted taxable profit or loss for that particular year. However, before we start, there are some few adjustments I would like us to make to the question because of the changes in the law, and especially for capital allowance rates. The capital allowance rates that are applicable now are supposed to be for the year 2020. So because of that, the question cannot go with the way it is. Otherwise, it was examined when we had the old rates. So the first adjustment I'd like us to make is in additional information number 1, where we are told that the company operates in a factory building whose construction cost at the time of first operation was 1st January 2003. Now, instead of 2003, I want us to make it 2016. Yeah? The year of income is 2017, but I want us to make it 2016, that it was put into operation on 1st January 2016. The next one is on the same additional information towards the end. We are told the cost of this building is included in the director's emoluments. The company installed processing machinery costing 2,800,000 in year 2003. That I would also want to change to year 2016 so that it can go hand in hand with the current changes in capital allowance rates. Now, with that, I told you the best thing you can do is to always look at what you are required to do. And number 1 is the adjusted taxable profit or loss of the business. Now, we said whenever you are asked to get the taxable income of any business, you ask yourself, which method am I supposed to use? And in this question, it's very clear because we can see we are given the income statement, and after towards the end of the income statement, we are given the net profit. So that tells you that automatically we are supposed to use the net profit method to get the taxable income. So how do we go about it? We start with the name of the business. So we said whenever you're using the net profit method, start with the net profit provided. you adjust it to get the taxable income. And the first adjustment is to add, where you add two items. One is the non-allowable expense in P&L. An expense that could have been deducted in the P&L to get the net profit down here, that one, and it's not allowable, so you add it back. And then later on, we'll go to the additional information and look for taxable operating income omitted in P&L. But that is now after we are done with the first part. So we go through the income statement, we look for the non-allowable expenses. The first expense is the director's emoluments. We said anything paid to the directors for service rendered, that is supposed to be allowable expense. Director emolument for the company, we said is allowable. The next one is provision for depreciation. We have always said that depreciation is not allowable. Instead of depreciation, we allow capital allowance. So this is not allowable. The next one is office furniture, a fixed asset. Fixed assets are usually not allowable. The next one is the computer software, another fixed asset. We don't allow. The next one is donation. We say donation unless you are told to a charitable organization, which we said are like children's home, Red Cross, churches, mosque, schools. They are not usually allowable. So this one is a general one. We are not told donation for which organization, so we don't allow. The next one is the legal expenses. Legal expense we said is allowable unless it is specified which ones, and then they fall in the category of non-allowable, but it's always allowed. The next one is the dividends paid. When we were looking at the additional non-allowable expense for the company, we said any form of dividend is not allowed. So this we don't. The next one is the corporation tax. Corporation tax, any form of tax we said are usually not allowed. So corporation tax is one of them. The next one is the salaries and wages. Salaries and wages we said that is usually allowable expense. Now that marks the end of the expenses in the P&L. So seems like we are in the end of this one. So we go now to the additional information and we look for taxable operating incomes omitted in P&L. An income that was supposed to be added in the P&L to get the net profit we are given, but it was not added. So that means that the net profit we have is less. So we need to add it. However, we said as long as we go to the additional information to look for a taxable operating income not in P&L. But at the same time, we might find more information of the expenses in the P&L. If in that more information we are told there's some aspect of the expense that we have said are allowable in the P&L, but that part is not allowable, we still come back and say, since that expense is still in the P&L, and there's some part which is not allowable, we still come and add it. So we start with the additional information number one. The company operating in a factory building whose construction cost at the time of first operation was 1st January 2016. Remember we changed that, 2016, was 4,800,000. The cost of this building is included in the director's emoluments. Now in this case we are told it's a cost of a factory building and which is included in the director's emoluments. Director's emoluments is an expense in the P&L. And we know very well the cost of fixed assets, just like these ones, are not allowable. So that is not supposed to be allowable. Factory building. The cost of the factory building, 4,800,000. After that, we continue. The company installed processing machinery costing 2,800,000 in the year 2016. Now, the processing machinery cost is a fixed asset, yes, but it is not relating to any expense in the P&L. Unlike the factory building, which we are told it was included in the director emolument, the processing machine we are not told it was included. So that we cannot add because it's not in the P&L. We go to point number 2. On 1st July 2017, the company acquired portable packaging machine at a cost of 420,000, computers 240, and weighing scale machine 48,000. All those are cost expenses relating to fixed assets, but not any one single of them is in the P&L. They are not relating to the expense in the P&L, so we leave them. We go to number 3. On 1st October 2017, the company put into use a staff canteen constructed at a cost of 780,000 and go down whose cost was 600,000. Again, those are costs of fixed asset, but those costs we are not told they are in the P&L, so we ignore. We go to point number 4. Legal expenses include. Now, legal expense is an expense. Is it in the P&L? Yes. If you go to the P&L, you find legal expense of 648. So we need to determine if there are some components which are not allowable in that legal cost. Now, legal costs include cost for disposal of banned packaging materials. Now, we say that legal costs relating to criminal activities, crime, is not allowable. Where is the crime here? It was banned packaging material. What were they doing with the banned material? So that cost is not allowable because it's relating to crime. So, cost of disposal, 27,000. The key thing here being banned. Another cost that was included in the legal cost is negotiating a loan agreement. We have said that any cost relating to loan, debentures, bonds, we don't usually allow. So we don't allow because of that. So, cost. Next, processing legal document for a new factory plant, 19,800. Again, we had said any cost relating to fixed assets, what we call conveyance fee, is usually not allowable. Here, it is relating to factory plant. We don't allow. Another one is defending a company against lawsuit for smuggled goods by a director. That is also not allowable. Why? Smuggling, a crime. Legal cost relating to crime, we don't allow. After that, we have the last cost there, preparing patent documents for registration. Again, we had said under the legal costs which are not allowable, legal costs relating to patents, copyrights and trademarks, we don't allow. So here we have the patent, we don't allow. That is the end of point number 4. We now go to point number 5. Don't forget, we are still looking for non-allowable expense in P&L and taxable operating incomes omitted in P&L. So if you look at point number 5, gross profit was overstated by 20%. Now, gross profit is an income, and that income is in the P&L. If you go to the P&L, there is gross profit. So we have to ask ourselves, when the gross profit was overstated, how did it affect the net profit? The net profit given down there, which is this one. Now, automatically you overstate the gross profit, you expect the net profit down there to be more. So this profit is overstated. And how do you adjust if this net profit is overstated? You need to deduct. Deduction is later on, not now. On the same point, we are told an include figure for purchases of 340, which had been understated by 15%. This, I think, we had looked at when we were looking at the taxation conversion of a partnership to a limited company. And we said that when you are given about purchases, when you are given the opening stock and closing stock, you have to look at the impact it has on the cost of sales. See, if the purchases was understated, remember, to get the cost of sales, we normally say is equivalent to opening stock plus purchases less closing stock. So if you're told that this purchases was understated, so what happened to the cost of sales? Cost of sales also was understated because purchases we normally add. So we add something little, you have something little here as the cost of sales. Now, cost of sales is an expense. If an expense is deducted less a figure, you expect that the net profit that you will end up having down here would be more because you deducted less cost, less expense. So this profit is overstated. So how do you adjust? Again, you are going to deduct. So deduction is later on, not now. So we are done with the point number 5. We have seen all of them require that we deduct them. We go to point number 6, where we are told director's allowance include management fee of 495,000 from a director of one of the subsidiary companies. Director's allowance include. So director's allowance, is it in the P&L? Yes, it is in the director emolument, because director emolument is a general term that include any benefit or any amount that was paid to the director, the salary, director fee, commission. So we are told that now in that director allowance, which is in the director emolument, it include management fee of 495,000 from director of one of the subsidiary company. So question is the management fee allowable? Yes, management fee is allowable. But is the one paid in relation to a subsidiary company allowable? No. Every company must stand on its own. Actually, the next topic, as you can see here, is about taxation of the group of companies. When we will be looking at the taxation of the group of companies, we are going to learn that a company cannot bear an expense of another. It has to stand on its own. So that expense need to be taken to the subsidiary. So we don't allow it in this company. So management fee. After that, we go to the point number 7. Interest on loan of shillings 96,000 from the head office was included in the director's emoluments. The interest was to be treated as received from a thinly capitalized company. So it's about interest on loan. Is it P&L? Yes. We are told it is included in the director's emoluments. Is the interest on loan allowable expense? Yes, it is. But now, they are talking about the interest being treated as received from a thinly capitalized company. Now, there's something called thin capitalization. Thin capitalization we are going to look at. Yeah, there's a topic about tax planning. In the tax planning, there's something called capital structure. We'll learn more about thin capitalization there. However, at the moment, because we may be using it before we get there, what you need to know is this. If an expense is paid to another related company, and that other related company is located outside Kenya, the related company can be a subsidiary, a parent company, a joint venture, or an associate, which is located outside Kenya. That expense is not allowable. According to the government, that expense can be used to evade tax. So where is the connection with the thinly capitalized? Now, when you get there, we are going to learn, when you talk of thin capitalization, it's what I have just explained. Being paid to another related company located outside Kenya. That expense is not allowable. So this is not allowable, and it is in the director emolument, which is in the P&L. We disallow it. So interest on loan, in bracket, thinly capitalized. Point number 7 is the last point in that question, in the additional information. So that tells you that we are at the end of the items that we are supposed to add. Now we come to the items we are supposed to less. There are usually 3. So we need to go to the question and look for these 3, where we are supposed to look for non-taxable operating incomes in P&L, meaning these incomes that are in the P&L, any that is non-taxable, we deduct, because if it is in the P&L and it's not taxable, it increases the net profit that we ended up having down there. Not taxable, we deduct. We also deduct all investment incomes in P&L. If there is an investment income here, we deduct so that we remain with operating income. That is what we said. And then in the end, we are going to look for allowable expense not in the P&L. Expense that are supposed to be here to be deducted to get the net profit, they were not deducted. Those we saw, we are supposed to go to the additional information. So we start with the incomes in the P&L. We look for non-taxable and investment. The first income is the gross profit. Gross profit, we say that is supposed to be a taxable income. However, there is an additional information on it. Additional information number 5, which say gross profit was overstated by 20% and include figure for purchases of 340, which had been understated by 15%. And we saw that when you overstate the gross profit, the net profit down there become more. So this net profit here is overstated. So we need to deduct that overstatement of the net profit. So we come here and say gross profit overstated. The gross profit is 11,520. And we said, when you're told it's overstated, you know, most people make a mistake of less. Like now, we are told it's overstated by 20%. So they just take 20% of that figure. No. We said you look at it this way. If it's overstated, this figure must be at 120%. And what do you want? You want the overstated percentage, the 20%. So if this 120, 20% will be equivalent to what? So cross multiply, it will mean that you multiply by 20 over 120. So 11,520,000 times 20 divided by 120. That is 1920,000. And then on the same point of number 5, we were told that, and it include figure for purchases of 340, which had been understated by 15%. And again, we said that if you understate the purchases, you understate the cost of sales. If you understate the cost of sales, which is an expense, you end up having more net profit. So that again, we are supposed to deduct. So understated purchases. The purchase we are told is 340. Now again, if it is understated by 15, it means that we take 100 minus 15. That's 85%. So that means that this figure is 85%. And what do we want? We want the understated percentage, the 15%. So if this 85, 15% will be equivalent to what? So cross multiply times 15 over 85. 340,000 times 15 divided by 85. That gives us 60,000. After that, we go back to where we were. Remember, we are still in the P&L looking for non-taxable operating income and investment income in that P&L. So the next one after the gross profit is foreign exchange gain. For the foreign exchange gain, we said it's always taxable unless you are told unrealized. It's always taxable. So that's okay. Next one is the dividend from Hazina Cooperative. We said that dividends are investment income. And here we are saying all investment income must be deducted. So dividends, Hazina Cooperative, that must be the society, which we have 68. And we normally deduct the amount that was added. You see, somebody may say, it is net, let me gross it up. Don't. You deduct what was added, whether net, whether gross. So what was added is 68, so deduct the 68. Another one is the dividends from subsidiary company. Another investment income. Dividends are investment income. So dividends, subsidiary. $244. Now that is the last income that we have in the P&L, and that means that the first part are over. The non-taxable operating income in P&L or investment income in the P&L. Now we look for allowable expense not in P&L. An expense that was supposed to be deducted in the P&L, it wasn't deducted. So it means that now the net profit that we are having is more. So we need to deduct. So if it is not in the P&L, where do you find it? You normally find it in the additional information. So we go through the additional information, look for allowable expense not deducted. The first additional information, number 1, says the company operates in a factory building whose construction cost at the time of first operation was 1st January 2016. We changed that. Was 4,800,000. Now, is that cost in the P&L? Yes, we are told the cost of this building is included in the director emolument. Director emolument is in the P&L, so we are not interested in that. We go to the next one on the same point. The company installed a processing machinery costing 2,800,000 in year 2016. Is that cost in the P&L? No. We are not told that is relating to any expense in the P&L. Is it allowable? No. Why? It's a fixed asset. What do we allow for the fixed assets? Capital allowance. Which one? Is a processing machine. Processing machine, we said we claim investment deduction. How? This. If you look at what we said when we were looking at the capital allowance, we said that investment deduction first year is 50%, and then 25% reducing balance from the second year. So in this case, which year are we in? We are in the second year. We said 2016. So it was acquired in 2016. We are in the second year of 2017. So that means that we take 25% of the original cost, which was 2,800,000. But we said all capital allowances are on a reducing balance. You have to minus the capital allowance of the previous year. So what was the capital allowance of the previous year? It was only 2016, where the capital allowance was 50%. So 50% of 2,800. So this will give us the written down value and then 25%. So we start with 50% of 2,800,000. That is going to be 1,400,000. So that being the investment deduction of the first year, the written down value would be what? 2,800,000 minus 1,400,000 give you 1,400,000. So we take 25% of 1,400,000. We have 350,000. So there. After that, we go to point number 2. Because additional information, number 1, we have exhausted for allowable expense, not in P&L. Number 2, on 1st July 2017, the company acquired portable packaging machine at a cost of shillings 420,000, computer 240, and weighing scale machine 48,000. Now we saw those costs again, they are not in the P&L. But are they allowable? No. Why? They are fixed assets. Fixed assets we claim capital allowance. So we need to know which ones for each one of them. And we start with the portable packaging machine. If you go to the capital allowance, we said packaging machine is a machine that assists in manufacturing. A machine that assists in manufacturing qualifies for investment deduction. So investment deduction. So a short form of the investment deduction is ID. So we have ID of packaging machine. And which date are we supposed to use? It is the first year, July 2017, that year. And we don't consider time. We say that because it was 1st July to the end of the year, those are, we don't in capital allowance. So we give a full year. So being the first year, we'll take 50% of the 420,000. That is going to be 210,000. And the next one is the computer. Computer, we know that is wear and tear allowance 25%, and it is the first year, so there is no reducing balance for that. WTA for computers, 25% of the computer. We have 240. %, of 240,000, that give us 60,000. Then we continue. After the computer, there is weighing scale machine. For the weighing scale machine, that's supposed to be wear and tear, which rate? 10%, and it's the first year. So we claim wear and tear 10%. That is 4,800. And then we continue to point number 3, where we are told, on 1st October 2017, the company put into use a staff canteen constructed at a cost of 780 and a godown whose cost was 600,000. Now, other fixed assets, are they in the P&L? No. So we claim capital allowance. Which one? If you go to the capital allowance, we say staff canteen, IBD. Godown, IBD. Which rate? 10%. On a reducing balance, but this is the first year, and we don't consider time. We say that because it was from 1st October 2017, we consider 3 months. We don't. It's a full year. So, industrial building deduction, what we call IBD, of, we start with the first one, staff canteen. So that is supposed to be 10% of 780. That is 78,000. The other one is the go down, 10% of 600. That is 60,000. So for point number 3, done. We go to point number 4. Legal expense. Is it in the P&L? Yes. Remember, we are looking for expense not in P&L, so we leave that out. Number 5, there is no expense in number 5. Otherwise, they are also in the P&L. Director, number 6, director allowance, is it in the P&L? Yes. Number 7, interest on loan, is it in the P&L? Yes, because we are told it's in the director's emoluments, which is in the P&L. So seems like we have run out of the allowable expense not in P&L, but not so fast. Why? Because we said once you are done with the additional information, come back here, look for fixed assets that you said are not allowable, and so you added them back so that you can claim capital allowance. Like which one? Here we have office furniture that require wear and tear at the rate of 10%, computer software, wear and tear 25%, and you go down factory building. That's supposed to be investment deduction, ID, investment deduction. And this, if you look at additional information number 1, that's where we were told it was acquired in 2016, last year. So that means that it must be on a reducing balance, and there isn't any other fixed asset that we had added back. So we claim the capital allowance for the 3. So we start with the wear and tear allowance for the furniture. So 10% of 360, that is 36,000. The other one is the wear and tear on software, 25% of 90. %25 of 90,000 give us 22,500. Then we have the factory building. So that we said is ID, investment deduction for factory building. And since it's the second year, you know, it was acquired in 2016 and now we are in 2017, we take 25% off. The original cost was 4,800. And now, first year, that is 2016, they claimed 50% of that 4,800. This gave us 400,000. So 4,800,000 minus 2,400,000, that gives us 2,400,000. Then 25% of it, $400,000, give us 600,000. Now that there is no other fixed asset that we need to claim the capital allowance, what do? We can now get what we call the net taxable operating income. So we start from here. The net profit, we add the ones that we are adding, we minus the one that we are minusing. So we start with 2957, 500, and then we add 250,000, and then we add 360, we add 90,000, we add 25,500, we add 120,000, and then we add 375,000, and then we add 4,800,000, we add 27,000, add 36,000, and then we add 19,800, and then we add 94,000. Let me confirm that. 94,000, and then we add 52,800, and then we add 495,000, and then we add 96,000. So that gives us 9,798,600, and then now we minus the figures below, 19,20,000, and then we minus 60,000, we minus 68,000, we minus 244,000, we minus 350,000, then we minus 210,000, then we minus 60,000, we minus 4,800, we minus 78,000, we minus 60,000, we minus 36,000, and then 22,500, and then we minus 600,000. That gives us 6,085,300. That is the taxable operating income for the company. And we said since it is positive, you don't stop there. You add taxable investment incomes for the company, because you normally tax the company on its own income. So, do we have the investment income? Yes, they were two. In our income statement, we had two dividends. One, dividend from Hazina Cooperative. Now, that is a cooperative society. If you go to the categorization of dividend, we said, dividend from a cooperative society other than SACCO, it is a non-qualifying. Withholding tax is not final. We need to tax it further. How do we tax it further? By adding it to other taxable income. And here you can note, we are told it is net. Remember we said we don't tax net income, we tax gross incomes. So we come here and dividends, Hazina Cooperative Society, the amount is 68,000. Now, when you are told it is net, we said it is after deducting 15% withholding tax. So meaning this figure is 85%. So how about 100? Because we tax the gross, the 100 before we withholding tax. So to get 100, you need to multiply by 100 over 85. So we have 68,000. And then we multiply by 100, divide by 85. We have 80,000. That is one. The other income is the dividends from a subsidiary. Dividends from a subsidiary. If you go to the categorization, okay, first of all, let us understand what is a subsidiary. From accounting perspective, we note subsidiary is a company where the parent company, the company that has shares in this subsidiary, control more than 50% share. That is what we call a subsidiary. Now, what is the implication? If you go to the categorization of dividend, we said, under exempt, if a company gets dividend from another, where it controls 12.5% or more of the share, those dividends are exempted from tax. So meaning, because this company is getting from a subsidiary, those dividends become exempted from tax. We don't tax them. So we cannot add them here because they are not taxable. And what does that mean? Since there is no other investment income, we can now get the total taxable income. So total taxable income would be the operating income, 60, 85, 300, and then we add 80,000. That gives us 61, 65, 300. That is the total taxable income. Have we answered the first question? Yes. Why? It was asking us to get a statement of adjusted taxable profit or loss for the year 2017, which we have done. So number 2, we are supposed to get the tax liability, if any, for that period. So tax liability. So we have the tax payable, which we call the corporation tax. This is now the corporation tax payable. How do we get? We said once you get the taxable income of a company, you tax the company itself at the corporation tax rate, which were resident 30%, except year 2020 when it was 25%, non-resident 37.5%, and those that are under EPZ, 10 years, no tax. From the 11, 25%. Where does this fall? This one, we are not told it's a foreign company. Whenever you're not told it's a foreign or an non-resident, all companies are resident. And since we are not told about the EPZ and the rest, so in that case, we tax it at the rate of 30%. Why? Because it's the year 2017, so 30%. So it's going to be 30% of the taxable income. The taxable income is 165,000. But that is not all. Why? That is 300. That is not all. Why? Because we said if you have an investment income and that investment income has been added here because the withholding tax was not final, it is a taxable, and it is subject to withholding tax, the withholding tax must be deducted from the tax to be paid. So for here we had seen there is dividend from Hazina Cooperative Society, and we were even told it was net and we had to gross it up. So the withholding tax need to be deducted. So we deduct 15% of the gross, the 80. Otherwise, you can also get the difference between the gross 80 and net 68,000. So how much is that? It is going to be, first of all, we deal with the first one, 30% of 6165, 300. That gives us 1849, 590. And then 15% of 80 give us 12,000. And now to get the tax, we take the 1849, 590, and we minus the 12,000. That gives us 1837. 590. That become the tax payable. Have we answered all the questions? Let's see. We had question number 1 we answered. Number 2 we have answered. Number 3 not yet. Comment on payment of tax for the year 2017, assuming that tax had been paid during the year 2017 based on the previous year tax of 2,400,000. So we are told to comment on the payment of this tax. Now, whenever you are told to comment about the payment of the current year tax, and again, they give you the tax about last year, they are talking about you to illustrate about the payment of tax in the current year in installment. So it's all about installment tax. Remember, we said that corporation tax is usually paid through installment. So what is the first thing that you do? First of all, you have to estimate, which we said is usually done at the beginning of the year, how much installment tax was supposed to be paid in that particular year. How do you estimate? Since this is not a starting company, we said we take 110% of previous year tax. And we can see here we are told the previous year tax was 2,400,000. So previous year tax is that. So, and you also be careful, because you can be given, instead of the previous year tax, you are given the taxable income. So if you're given the taxable income of last year, first of all, convert it to tax, multiply by the corporation tax rate, and then you get the tax of last year, and then you get 110%. But this straightforward, it is the tax of the previous year. So, installment tax estimated, because this is an estimate, is supposed to be 110% of the previous year tax, 4,800,000, that is 2,400,000, which give us 110% of 2,400,000. That give us 2,640,000. That is how it is estimated. Then, because you are told to explain, to comment, you must illustrate how it was paid. Once you estimate, we have the first installment. First installment, which we said is supposed to be 25% of the total installment, 2640,000. So So we have 25% of 2640,000. That gives us 660,000. When is it paid? You have to illustrate payable by 20th of April. Remember, we already have the year. The year is ending on that 1st December. So it started in January. So the 4th month is April. And the year, in the year of income, 2017. Then we have the second installment. Another 660,000. Remember, another 25%. 660. It's the same because we had already computed. When is it payable? Payable by 20th of June, the 6th month, 2017. And then the third installment, another 660,000. When is it payable? Another 25% of this one give you the same. So which is payable by 20th September, the 9th month, 2017, in the year of income. Then we have the fourth installment, another 660,000, 25% of the total, which is payable by 20th December 2017. By that time, you'd have noted you'd have paid 100% of the total installment, because 25, 25, 25, 25, you add this one, they come to this. So now when you get to the end of the year, you determine the final tax. But you don't know whether it is the final tax payable or it is the final tax refundable. So what you normally do, you wait and now compute. Although we can see that the tax the company was actually supposed to pay is this, they paid installment of this. So they paid more installment than the actual tax. So that tells you that they are supposed to be refunded. So we call that final tax refundable, which will be equivalent to, we said we take the actual tax, 18, that's 7,590, and we minus the installment paid 2640,000. So that gives us 18, that's 7,590 minus 2640,000. That gives us 802 negative, but don't write a negative. It should be an absolute figure. Why? Because you already have indicated it's a refund. So don't write a negative. It's a refund when it's a negative. And when is it supposed to be done? So by is supposed to be refundable, that is the expectation, by 30th April, the following year, 2018. And that is how we do an installment tax. We have also done the corporation tax, and if you look at the question, that means that we have answered Roman 1, Roman 2, and Roman 3, and that is the end of it. So that is how we deal with the corporation tax and installment tax. And that one brings us to the end of today's lesson about corporation taxation of the limited company, corporation, and installment tax. So in our next lesson, we are going to look at the taxation of the group of companies. Yeah, so, but I want to give you some few questions you can look at just to be able to practice on what we have done here. And the first question is November 2018, question number 2A. November 2018, question number 2A. The next question is November 2017, question number 5B. November 2017, question number 5B. So those are the questions that you can look at for your own practice, and the answers are here in our CPA Advanced Level Revision Partner, Advanced Taxation. So for any reference, in case you want to confirm whether you are right or to follow up, then you can get the answers from here. So I want to hope to see you in our next lesson, where we look at the taxation of the group of companies. But for now, See you in our next lesson. Thank you very much.